Institute, and specifically from National Review Institute's new economics publication, Capital Matters, which focuses on economic and financial coverage. And if you haven't checked it out yet, if you have, maybe you haven't, there's great stories on there about all types of public policy issues that are extremely relevant to us econ majors at Mason. And we know we're very much interested in that. And it's a great, unique free market perspective in this atmosphere of, intellectual environment and an environment of financial journalism that, isn't necessarily conducive to a free market perspective. Capital Matters does an excellent job at that. And our guests tonight, Andrew and Daniel, are going to be discussing journalists' role in the economic policy debate. So again, thank you everyone for coming out. And I'll turn it over to Amanda from National Review Institute, who will talk more about the program as well as introduce the nuts and bolts of our guests as well.
Awesome. Hello, everyone. Thanks so much for being with us tonight. I'm so excited to do this event. George Mason is my alma mater. Met my husband there, and George Mason put me on the career path that I'm on that landed me this job. So I owe a huge debt of gratitude to the education and the faculty and staff there. I had a wonderful, wonderful experience. I'm just going to briefly talk about our on-campus program for those who are unfamiliar. So our founder, William F. Buckley Jr., began his career as a public intellectual by writing God and Man at Yale, which was a scathing critique of his alma mater and its growing bias towards secular conservatism. Buckley understood how vitally important young people are to the future of our country, and he frequently spoke on college campuses throughout his illustrious career to promote the principles of classic liberalism and limited government. He actually was on record as, he would visit 50 plus campuses a year. Pretty incredible in addition to everything else that he was doing. So we continue that mission in continuing on the legacy of Bill Buckley, and also bringing the National Review mission to college campuses, where we try to provide opportunity for college students to learn the principles and ideas of a free society and a free market in the case of Capital Matters. So tonight, I'm so excited that we have with us Andrew Stuttaford and Daniel Tenreiro. Andrew Stuttaford is a contributing editor of National Review, for which he has been writing since the early 1990s. He took up full-time positions with National Review and National Review Institute in March 2020, and he is now the editor of National Review Capital Matters, which is our new initiative focused on financial and economic coverage. Prior to joining National Review and National Review Institute, Andrew, who qualified as an attorney in the UK, worked in the international finance markets for nearly 4 decades, latterly as the CEO of the US subsidiary of a Nordic investment bank. Andrew has written for a wide range of publications over the years, including the Wall Street Journal, the New Criterion, the Weekly Standard, and Standpoint on political, economic, and cultural matters, and has been writing for National Review since his debut with the magazine in 1992. Daniel is our current Thomas L. Rhodes Journalism Fellow at the National Review Institute. He edits NR's economics and business commentary and co-authors the Capital Note, which is a daily newsletter on finance and economics. Daniel grew up in New York City and studied economics at Yale. And as an undergraduate, he wrote a biweekly column for the Yale Daily News and served as project chair of the Yale Hunger and Homelessness Action Project. So thank you so much, Daniel and Andrew, for being with us tonight. We really appreciate it.
Thanks, Amanda. I think I'll start. So thanks everyone for joining. I was an econ major not too long ago. And I suppose the topic today, because Andrew and I are both journalists who cover finance and economics, and Andrew is previously a professional in the field, is economic journalism, the interaction between kind of ongoing economic debates and journalism. And on this topic, I always think of this piece written by Amber Ailey Frost, who is I don't know if any of you know who she is. She's a podcaster with Chapo Trap House, which is a kind of communist podcast. Dirtbag, they call themselves the Dirtbag Left. But she wrote a kind of like shockingly good piece for the Columbia Journalism Review a couple of years back, called "Why the Left Can't Stand the New York Times." And so to quote her, she said, "By literally any measure, the Financial Times is just a better paper. and that's because it covers the world as it is, a global battle not of ideas or values, but of economic and political interests. And I would say, there's a lot of, obviously, she's coming from probably a different ideological position than a lot of us, but I think a generous reading here is that something about being, if you're a journalist and you're in the world of business, of finance, of economics, there's an objectivity that's kind of imposed on you, mostly because of prices, basically, and kind of hard data. It's generally kind of difficult to superimpose ideology onto the fluctuations of the stock market or changes in unemployment or GDP and the like. And I would say that that's kind of what attracts me to, as somebody who for a long time has been writing as an undergraduate for the campus newspaper, and even in high school for my high school paper. I'm kind of attracted to the discipline that the hard data imposes in economic journalism. It's funny to think back to, first there's during the 2016 election, the night of the 2016 election, I don't know if any of you recall, but stock futures plummeted very suddenly and then rallied almost immediately after. And the coverage leading up to election night was that if Trump won, that markets would sell off dramatically. I think that traders believed it for like 3 minutes on the night of the election, and then maybe somehow had an epiphany. I would say the same goes for 2020, and it's not just, so the election is one thing, where whatever forecasts one might have about the outcome of the election, like probably most investors and business people were horrified at precisely the outcome that we saw, which was a relatively narrow victory for Biden. That was then contested, but markets held up, economic data held up, jobless numbers looked good. So this is the kind of thing that makes commentators have to check themselves a little bit, right? It can't quite be the disaster that some thought it would be if basically in the world of data, of prices, of business, things are going relatively well. A few other examples. I mean, the pandemic really, I think this year has been, obviously it's been a devastating year in many respects. It's been a really interesting year as a financial journalist, not only because so much happened, but also because of this question of what prices tell us. I mean, as stocks and a variety of other financial securities soared in the maybe May through August, I mean, basically May through the present period. Early on, a lot of the commentary, especially in the big newspapers and magazines, was that the stock market has become totally disconnected from reality, from the real economy. This is insane. But stocks and financial assets in general are a leading indicator, right? And it turns out that basically financial data, economic data, really gave a kind of stunningly accurate picture of reality. Most of the sell side research, most traders figured that we would have a vaccine roughly around January, March. That is probably when we're going to get it. So the point that I'm trying to make is that in a good world, economic journalism, and by extension the economics profession, is something that disciplines our view of the world, right? And that's something that's foundational to the discipline of economics. I'm sure that you're all familiar with Hayek, and the point, maybe his one big thing, his one big insight is that prices aggregate a lot of wisdom and a lot of kind of practical knowledge, and can tell us a lot more than we can know otherwise. But unfortunately, it's increasingly not the case that particularly economic journalism, but also maybe just the commentary on economics in general, is rooted in this objective picture of reality. Just today, I was thinking, as I was preparing for tonight, I was clicking through Bloomberg, and there's a piece today from about a Harvard economist who's now publishing, a very celebrated economist who's probably going to have all sorts of think tank affiliations and awards and the rest. But he's publishing valuations of companies that not only are based on their expected future earnings, but now also include environmental issues and diversity and the wages that they pay workers, and do they get overtime and time off. And so it's basically an ESG score, but in dollar amounts. And this is somehow as being celebrated as like groundbreaking research, but it's exactly what distorts the aforementioned discipline of prices, right, and of markets. And so I guess the question would be, not to go on too long, I'll try to wrap it up quickly, but the question is like, why is, and you all as budding economists, or at least if you're econ majors in undergraduate programs, at the very least, I would assume you have an interest in going into business or economics. You have to be thinking about, why is it that that these kinds of questions that for a relatively substantial period of time were rooted in objective reality are no longer seem to be. And the two, as a journalist, and then as also somebody who just follows these things, you would think one factor is that we are entering a pretty strange period in economic policy. Obviously, I'm sure you all in your undergraduate textbooks, you learn about the Phillips curve and the quantity theory of money. Obviously, we've had a massive amount of money printing over the past 12 years or so. What I learned as an undergraduate, what I assume you learned, was that this should cause inflation. It hasn't. So there's this perennial question over the past now more than a decade of what's going on. And these kinds of basic assumptions, theories, I don't know the precise word to use in this case. But when we can no longer assume that, for example, an expansion of the money supply, all else being equal, should increase prices, you have kind of knock-on effects where then suddenly you can find yourself in a position where basically the dominant view now is something akin to modern monetary theory, which is an increasingly kind of dominant mode of thinking, especially during the pandemic. There's been no question of no hesitation by fiscal authorities or monetary authorities to stimulate the economy. So this kind of new environment raises a lot of questions that you all, if you go into the economics profession as academics, are probably going to be thinking about for a long time. Maybe you'll even solve it. And then in the business world, this is interesting too. And I find this, Andrew and I cover business a lot. It comes up a lot in the startup and tech world, because it's very hard to distinguish between basically a fraud and a hugely important transformational company. This year we've had, just in the past, so DoorDash and Airbnb are going public this month. Last month, we had Snowflake, this kind of data company, and Palantir, all these blockbuster IPOs, companies valued at tens of billions of dollars just shortly after their founding. And it's hard when you're trying to have an objective picture of reality and trying to look at the future. Novelty presents difficulties. So again, I think that the coverage, the financial coverage and the tech coverage of these companies often it's kind of a Rorschach test for where the reporter or the commentator is coming from ideologically. A lot of people really hate Silicon Valley. A lot of people think they're saving the world. And then finally, the last factor, and probably one of the most important, and this is endogenous to the media. It's not a part of the changing economy or business world, but is that the media business model has obviously changed. Newspapers and magazines don't have as much funding. A lot of the economics now go to social media platforms. So you have fewer resources to do deep investigative work. You also have more of an incentive to be sensationalistic. So which does breed these more ideological stories. So I suppose the upshot of all of that is that there's a lot to, especially after the pandemic, but even beforehand, there were a lot of questions that we took, whose answers we took for granted that we basically no longer can. And I would say that, James, your classmate and I guess club mate, mentioned that he's interested in journalism. I would say that if you're interested at all in these issues, you have to think pretty hard about what does the objective data tell us, and how can we use that to kind of make economic judgments, and then where is it insufficient, and where do you have to where as academics do you all have to think about what kinds of questions to explore. So I'll leave it at that. Andrew, I don't know if you had anything to add to that.
No, I mean, Dan, that was great. I mean, I guess I just have a couple of brief things to add. Firstly, on predictions, if you go into financial journalism, you have to be very careful. Already, the markets, you have to be very careful with predictions. I always get things wrong. But you were talking about 2016, and I was talking to I used to do a thing with talking to the Danish equivalent of the Financial Times, which had a sort of TV channel of its own. And so I did a couple of things over 2016 and over election night. And they said, "What are your projections?" And I said, well, if it looks like Trump is going to win, financials will go up, gold will go up, and the markets will go down. And indeed, that is what happened. If you looked at, we were doing it Danish time, that is indeed, if you looked at the futures, that was exactly right for about an hour. And so the next morning, the Danes are blunt people, and they said to me, "Well, it seems you were completely wrong." And I said, "Well, not for an hour." And so, you have to remember that every prediction you make is like water. They come and go because markets change continually. And why they change, no one quite knows. For example, there's the question about the strength of the market that we have at the moment. A lot of it derives from the reasons that Daniel gives. But we also have to, if you're writing about finance, you have to think about it from the point of view of an investor. And which sounds obvious, but perhaps it's sometimes more tricky than one thinks, which is one of the reasons that people are investing in stocks is because there's nothing else. If bonds are yielding you a negative real rate, or even a negative nominal rate, or something much above it, then you are driven into stocks. Your PE ratio is the inverse of essentially of interest rates. And so it actually makes more sense to be buying stocks than the numbers might suggest, which doesn't mean that all hell won't be unleashed the moment the interest rates go up. So you're writing about it, you have to think about it from what is the investor thinking. And what the investor is thinking at every moment is, where am I going to put my money now? I had a client who years ago, a great guy, and on my recommendation, he bought a particular stock. And this is before really mobile phones were sort of a big thing, to date myself. And he made a lot of money out of the recommendation. He was up 100%. The company, or thereabouts, the company came out with a poor set of numbers and sold off 20%. So for the sake of argument, he was still up 80%. And I happened to be I was on a roadshow, I happened to going to see him. And I said, and his eyes were slits of anger and disappointment. And he said, "Well, you did remind me, you did say, but even so, this is grim." I said, "Well, you're up 80%. And he said, "That's not how I see it. At the end of every day, I decide, am I going to buy this share, or am I going to hold the share or not?" And I think that when one writes about stock markets, one has to try and make an effort to understand what people in the markets, how they see things, and how they see things isn't as intellectually neat as is sometimes imagined outside the markets. The only other thing I would say, as Daniel did such a good job, is that part of the role that we're trying to do at Capital Matters is just explain stuff. Because as Daniel said, you know, the numbers are all and the facts are all, and certain facts can't be wished away. And during the financial crisis, I can't remember, 2008, 2009, there was a big debate over whether to support the TARP program, which was the only thing going to support the banks. And I was asked by the magazine, what did I think? And I said, well, I don't like it. It's ugly, but it's all there is. And it comes to a point where you need a printing press in the room because you don't want to see what happens if the banks collapse. And I said, we had that debate in the early 30s. We don't need to go there again. And so it was agreed, and we supported with huge limitations the bailout, well, not the bailouts, the support program. And and a bunch of people were saying to me, sort of right-wing journalists were saying to me, Andrew, what have you become a communist? Why are you advocating this? And well, I said, well, the wheels are falling off. And I said, how do you know the wheels are falling off? And I said, well, the commercial paper market has completely frozen. There isn't any. And then everyone looked blank. And I said, okay, well, I'll be the jackass. Who knows here what the commercial paper is? And no one did. And so I said, and what it is the short-term lifeblood for many, many companies. And if you don't know those sort of things, and this is where I think economics journalists and financial journalists have to explain far more of the basics, it's impossible to come to the right or appropriate political decision or economic decision as to what to do. And I think that we take a lot of our decisions, not only in this country, in the blind, because people just don't understand stuff. But I think as a financial journalist, part of your job is actually to explain, not political at all. This is how it works. This is how it happens.
So I don't know if there are any. Yeah, James, you want to jump in?
Yeah, sure. All right.
Nice.
Thank you, guys. That was really interesting. Now we'll open it up for questions. And in the meantime, I guess I could ask a couple questions. First thing that comes to mind, who, for financial journalists in general, not necessarily just for Capital Matters, who would you say the target audience is? Like, would you say it's predominantly like the investors, like Andrew was talking about, or is it just lay people, the average reader, like who will listen, or like who's the target audience?
Who's going to take it? Dan, are you taking this?
Oh, sorry. I didn't address it.
Maybe we can both, do you want to start, Andrew?
Yeah, I'll start. The answer is it depends. That's always a convincing and a marvelous response. No, if you look at something like the Financial Times, there are a bunch of papers or publications which are geared for a specifically professional audience. Very few people, I think, read the FT who are not profoundly interested in economics, the markets, or business, because that's what you're going to. That's what there is cultural coverage. I had a friend who many years ago was their sports correspondent, would you believe? That was a complete failure. And so there you've got a professional audience. They basically know what's going on. A lot of them read it because it is a must-have. You want to know the second quarter numbers of Zoom and what are the implications. So that is appealing to the trade. The same would go with Barron's, which is aimed more at the sort of perhaps more at the personal investor. Then you look at something like the Wall Street Journal, which is a crossover, where you have a lot of information. I can still consider it a paper of record, where you have a lot of invaluable financial information, which is read, and I can tell you, discussed every day. From my years in the business, it's discussed every day by people who work in the business. Did you see that in the journal? Did you see that comment, and so on and so forth? But at the same time, I think that there is a role. My father used to be a medical journalist. He was a doctor, but part of the time he was a medical journalist. And when he first took up that job, his editor said, well, how do I pitch this? And he said, don't dumb it down too much. Pitch it at the intelligent layman. And I think that is actually what we at Capital Matters are trying to do, but also what the Wall Street Journal does in a lot of its coverage. You don't have to be a specialist to understand large chunks of the paper, but you have to be an intelligent layman who takes an interest. And that, I think, is the key market for financial journalism. What I do wish is that in more broad spectrum newspapers or websites or publications, there was greater financial literacy, but there's not.
To follow up on that, do you think that was something that motivated the founding of Capital Matters?
Yes. I mean, the discussions went on and off for years, and sort of crystallized more when National Review Institute came on the scene. But there was this sounds unbelievably pompous, but there was a sense of a little bit of an educational mission, in that if you go back to the 2010 crisis, well, or 2008-9 crisis, I always think of the Eurozone when I think of crisis. The people are saying, well, ideologically and intellectually, let's all burn it down and start again. To which one has to say, well, have you thought through what that will mean? And I am astonished at how often I read in the newspapers, left or right, more often left, about how there is a basic lack of understanding as to how things work. There was an article in the New York Times the other day about a bunch of rich heirs, and who moved to who were now bankrolling, left with people accepting causes without disturbing their lifestyle too much. But one of them made the quote, "I realize that I'm only making money, which is from investments, because at the expense of other people not making money," which is a view of wealth as a zero-sum, the creation of wealth as a zero-sum game. And honestly, no one should believe that anymore, any more than they should believe, some of Marx's theory, but they still do. And it would be very good as there had been more general publications. Occasionally they would run articles saying, this is why this is wrong, or indeed this is why this is right.
I would also add to that I think on the, let's say, I'm sure that you all have various political views, but National Review is a right of center publication. And I think that one of its, probably one of its unique values or places where it adds value is that it incubates a lot of policy discussions in certain areas. I know that on a lot of, on the courts, on gun control, on a lot of policy questions, there are lawmakers who are kind of following what we put out there. A lot of the economic thinking from the right, in my opinion, just speaking for myself, has grown a little bit stultified. Like all we know how to do is cut taxes and cut regulation, or at least try to cut regulation or pretend that we're cutting regulation. And that's not really a winning, in my opinion, again, and I'm not even sure if this is really, part of the founding mission of Capital Matters, but it's part of why I value it, is that people like excitement, they like novelty. And if you are offering kind of boring old ideas, then you're probably not going to win a policy debate. And especially once those, after 2017, it's like there was this sense that what is the point of economic policy on the right? They cut taxes, right? And they were cutting regulation, so it's done. And in a way that criticism is accurate. On healthcare, you saw this too. Not that we run stuff on pharmaceuticals and on the kind of economics of healthcare, but on healthcare is this thing where we've been complaining about Obamacare for so long. Economists have been pointing out all the problems with Obamacare, and then you there's still not an alternative. So I would say that we would like to be a publication that is incubating some policy ideas, which frankly the other ideological other papers of different stripes have had better kind of policy, not better policy ideas, but more, I guess, policy ideas, even though they're wrong. So just adding that.
I think that's right, and just to supplement that, what Daniel had said. I mean, I think one of the ideas of Capital Matters. I mean, to my sadness, it is not 1980 forever, and we have to recognize that things have got stale, and are not also a winning combination. But also that, what we have to, there's too much of the sort of hunt the heretic attitude, and that is not really, that's never really been a National Review thing. We've always had the policy, especially if you look online in the magazine, where we have had people who felt X, Y, and Z, so long as it's sort of somewhat the right of censorship. And so it is with Capital Matters. Here you have a situation where the economic debate, whether it's industrial policy, trade policy, taxation, and there are many others, is in flux. And it is absolutely fine to have a debate on the center-right or right, where writer X says, I think the way to go is this, and writer Z says, well, I think the way to go is that, diametrically opposite. And we are very happy to, so long as they're well reasoned and well thought through, we're perfectly happy to run both, and indeed side by side, because the best way you come to some sort of conclusion is to hash it out.
Awesome. We have a question from Nick. How do libertarian and conservative outlets gain ground in reporting accurately when so much of the media is biased toward Keynesianism and MMT, like Daniel mentioned?
Well, it's actually pretty easy, right? If you don't have, I think that a lot of publications are competing over the same readers and basically saying all of the same things. So it's actually a lot. We get to just we don't have to be that novel really in the way that we talk about, for example, monetary policy or stimulus in general, fiscal policy in general, because so much of the conversation is kind of one-sided. I would say that one challenge, and this is something that I struggle with too, is that when you are part of the problem of the profession of journalism, and I would say even of the economics profession in general, especially if you're looking at policy questions, is as we mentioned in the introduction with Hayek and the rest, it's like the economy is not policy, right? There's economic policy, and then there's the economy. There's economics as an academic discipline, and then there's economic policy. But in the day-to-day, what most people, you're not going to go and report on, such and such company opened a new factory. I mean, you might, but if it's Google or Amazon or something. But for the most part, it's a lot more exciting to write up the FOMC meeting or watch the Yellen speech on racial inequality or whatever. And so it's just like an inherent problem that a lot of, and this is in politics too, how much of civic life of our lives has anything to do with lawmakers? Hopefully not that much, but when you're covering these things, there's always a bias towards kind of power and policy. So I would say that one way is to try to cover different stories, try to cover actual businesses, try to cover things that are outside of Washington, that are outside of the halls of power. That's one way to do it, but that bias is kind of inbuilt.
Right. Another one. Do you think, I know Daniel, you mentioned about how data plays such a huge role in economic and financial journalism in particular. Do you think economic theory, or at least in your experience, economic theory also play a role? Do you find yourself applying that to stories that you write?
I think that you apply some theory. I would say that, it's good to know. So for example, one thing that, is another bias is that in the long run, as you all know, you have the solo growth model does not include any of these things that we talk about every day, right? Like it's just labor capital ideas. So you can cover ideas a little bit, and that's increasingly exciting because you can cover tech companies and the rest. But really, there's so much. So economic theory, the way I think of it, is like the places where it would come in journalism is in monetary policy. It comes in, and maybe in fiscal policy, because you'll say, you would expect tax cuts to stimulate the economy and vice versa. But in general, a lot of the most interesting discoveries of economics, let's say, can't really or are very difficult to integrate into daily commentary, because the day-to-day is by definition short term. And I would say that's another place where libertarian and conservative thinkers can do a better job, is to try to emphasize the long term more, try to emphasize and this on monetary policy, for example. I mean, this is a big one. It's like there's a lot, we don't, even if we don't get inflation in the next 5 or 10 years, if you can't, as Andrew mentioned, if you can't get a return on capital, that has all these downstream effects that might not materialize today or next year or in 5 years, but obviously have, as you can see it in Japan and in Europe, cause kind of deep structural problems, and problems that are so gradual in building up that they're difficult to integrate into daily coverage. But certainly, it's good to know economic theory. If I could give you one piece of advice, as people who are just a year or two behind me, it's that study micro as much as you can, because maybe it's because where I went to school or whatever, but I felt that people were much more interested in macro, and it ends up telling you a lot less.
Mm-hmm. Yeah, we definitely don't have that problem here. Don't worry.
Yeah, I would have guessed.
But no, it's definitely great advice.
I think that and you always have to put your again, if you're looking at financial markets, as to what people are thinking and why, and they aren't thinking economic theory. And for example, so you see interest rates are at 2%, 1%, or whatever it may be. Long-term rates less than 1%. So you think, well, surely everyone will invest their money. And the answer is no, they don't. And the reason is, firstly, that long-term rates are a signal of very ultra-low long-term rates are a signal of a lack of confidence that companies pick up on. And secondly, they don't really believe in them. I had a client for years who, and this was a running joke, he had the model. He ran the fund for a big state pension fund. And he had the model, and I'd ring up and say, well, you should buy X. And there'd be click, 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 click. And the model says it's trading at 140, and the model says it should be trading at 130. So I call him when it reached 130, having been proved wrong, and he'd say, unfortunately, the model now says it's at 120. After the financial crisis, when all the rates were nothing, basically, we were having a drink, and I asked him about that. I said, how's the model faring up these days? I said, so what rate are you putting in? What hurdle rate are you putting in? And the answer was they were completely making it up, because they did not believe that they didn't believe in these artificial rates. And so they weren't investing. They were putting in 5, 6, 7, or 8%. And so how people behave is very often bears very little relation to theory. And one other point I will add to this before moving to the next question. There was an interesting bit of research which we wrote about, which showed that one of the reasons for the lack of investment after 2008-9 was managers had basically repriced risk, because risk models anyway blew up in 2009-10, completely blew up. But beyond that point, the guy deciding whether to invest a factory or to buy a stock, whereas before he said the things I have to worry about are A, B, C, and D, and he never had to think about the complete collapse of the financial system or near collapse. Now there was a G that he added into his list of risks, and that increased the risk premium he was going to ask for and made him less likely to invest. And the same will now, I suspect, be true post-pandemic, as everyone, however remotely, will add pandemics into the risks that they have to start pricing for.
Yeah, I think that's definitely true now. Any last call for questions? Anybody else want to ask? Now's your time. Oh, here's another one. Let's see. Okay, how do you reconcile economics being thought of as I guess maybe this is more for Daniel with the academic background. How do you reconcile economics being thought of as a science with economic philosophies? Is it strictly a science, or is it more than that?
My general way of thinking about this is like you just have to separate the two as much as possible. So you shouldn't, like, I don't think that we should use economics as an academic discipline or as a science to inform policy or personal decisions further than the extent to which it's helpful. In other words, there are some models are, the one thing that I always say is that if the reality doesn't look like the model, then the reality is wrong, not the model, right? The reality is the model is unimpeachably correct. That doesn't mean that the model is going to be useful, but if what you learn from, if what the quantity theory of money tells, for example, if the velocity stays the same, if production stays the same, and your money supply goes up, prices will go up. That's true, right? So if somehow that relationship breaks down in the real world, the model is not wrong, right? What's wrong is the real world. There's something going on that doesn't make sense. So my general way of thinking about this is that economics as a discipline is useful up to a point. Really the insights are narrow and kind of basic and intuitive. And also that I think that my personal view is that the discipline of economics is not really going in the right direction. I'm not sure, I think that theory is much more useful than econometrics. I encourage you to stay away. I mean, maybe learn it, but if you want to do fruitful research, all this econometric stuff is never really going to tell you anything useful because it's based on the real world, which is extremely messy and difficult. So the econ is weirdly becoming more like the other social sciences for some reason, when for a long time it had a hegemony within the social sciences as the one accurate discipline. But the question was, how do you, so, it's, if you're thinking about the, like micro, recently, Ed Lazier, who actually, or I don't know if I'm pronouncing that correctly, Lazier, who was a Stanford economist, he recently passed away and he wrote for us, and I was going through some of what he wrote. And he was a microeconomist, and he modeled very narrow kind of contractual things between workers and executives, or between management and shareholders. And that's this very narrow discipline of what's called personnel economics is an area where you can glean some actionable insights. That's rare in economics. Most of it is you're studying it, you're modeling for the sake of modeling. And I think that's how it should be thought of. So I think, and I guess my answer to the question is that it should be strictly a science. I think that the focus on stats, the focus on behavioral economics is like a catastrophic error within the discipline, because it's moving more and more. I would even, I mean, I don't want to, I'll stop now, but I think that it could be causing a lot of downstream problems as far as the kind of debates that we have. So try to silo the studies from their application. There should be economics and there's applied economics, the way there's math and applied math and the rest.
Yeah, we definitely have similar conversations here at Mason along those lines all the time. I like how you turned it on its head, though, that reality is wrong, not the model. Usually we hear. But that's a good insight there. Looks like that's all the questions we had, but yeah, thank you guys so much for your insights and for joining us this evening. It was great.
That's our pleasure.
Thanks, everyone.
Thank you very much.
Oh, and by the way, I can give everybody who's on the call a complimentary subscription to National Review Magazine. If you're interested, email James and I will get him the coupon codes that are needed for you guys to do that in the instructions as well. But definitely keep up with us, follow us on Twitter, NRCap Matters. Daniel and Andrew are also on Twitter as well, always posting some great content. So keep in touch. Definitely don't forget about us and reach out if we can ever do anything for you or bring another program to George Mason Econ.
Yeah, sounds great. I'd just like to make an addendum to that. Actually, email the George Mason Economic Society address for the information. That'd be great, rather than myself. Everybody has that. Everybody has.
Sorry, I'm just sending all the emails to James.
To blow up my inbox. No. But everyone has that address, so that'd be a better place. And also, if you want to, we could send out the fellowship information as well. We could also do that.
Yep, absolutely.
Awesome. All right. Well, thank you guys so much for joining us. This is great.
Great. Well, thanks a lot.
Thanks, everyone.
Bye-bye.
Good night.